For, gosh, 2 solid years, it felt like the stock market story everyone was watching. Novo Nordisk.
Yeah, absolutely. This Danish company, founded way back in 1923, suddenly just exploded, became this massive healthcare player.
The most valuable company in Europe, right? Almost overnight.
Exactly.
Yeah.
And it was all driven by just, well, 2 letters really, GLP-1.
Ozempic, Wegovy, those names became household words.
They did. And it wasn't just about selling a lot of drugs. It felt like a fundamental shift in tackling obesity, diabetes.
The market certainly thought so. The hype was incredible.
Oh, completely frenzied. We saw Novo Nordisk's stock just soar. What was the peak? $142.43 back in June 2024. Just dizzying heights.
That kind of rocket ship growth always builds monumental hype, doesn't it? But
Yeah.
if you've been watching lately, well, that hype train seems to have derailed pretty spectacularly.
Yeah, brutal is the right word. A really rapid sell-off. The stock price, as of what, November 7th, 2025, down around $45.68.
Which is what, 57% drop over the last year? Staggering.
It really is.
Yeah.
The market essentially punished Novo Nordisk, like that whole obesity drug gold rush is just over, kaput.
Like it's pricing in peak hype and assuming the competition's already won.
Precisely.
Yeah.
Which brings us to the core question for today, doesn't it?
Yeah.
Has the market just completely overreacted here? Is this a blip? Or is this crash telling us something real about competition and pricing pressure finally taking hold?
That's exactly what we need to unpack in this deep dive. Can Novo Nordisk, this company with a long history of innovation, actually keep innovating fast enough to stay ahead?
Right. And for you, the investor maybe watching this unfold, is this massive pullback a genuine, rare opportunity to get into a leader? Or is it, a classic value trap?
Lots to dig into.
Welcome to Facts Not Forecast, your daily edge in the stock market. Facts, insights, and opportunities you won't hear anywhere else.
Okay, so let's set the stage properly. When people hear Novo Nordisk now, they immediately think GLP-1 obesity drugs, but this company's got history, right? Over a century.
Exactly. This isn't some, biotech startup that just got lucky. It's a pharma giant. Founded in 1923, they were the name in insulin for decades, dominant in diabetes care globally.
So they had these core businesses already.
Right. 2 main segments, basically. Diabetes and obesity care, that was the big one. And then a smaller rare disease unit, dealing with things like hemophilia, growth disorders, solid, steady business.
A classic, dependable healthcare stock. But then GLP-1s arrived, and the growth trajectory just changed fundamentally, from steady to, well, explosive.
Oh, the numbers tell the story loud and clear. Before this, stable, respectable growth, then boom, annual revenue growth jumps to nearly 35% in 2023.
Wow.
Followed by almost 25% in 2024. I mean, think about that acceleration. They went from being valued like a solid pharma company to being priced like a top-tier tech stock.
And it was definitely the obesity care part driving that, wasn't it? Even in the latest Q3 numbers, that division was still showing, 18% growth?
Unambiguously the engine. The market was clearly baking in this assumption that 30%, maybe even higher growth was just going to keep going forever.
Which, of course, sets you up for a big fall when reality bites, even a little bit.
Yeah.
When you're priced for perfection, any tiny stumble feels like a disaster.
That's exactly it. And the immediate trigger for this huge sentiment shift, the thing that really kicked off the panic, was the Q3 2025 earnings report. That came out November 5th.
Right, let's get into that. Because the top line, the revenue, actually grew, didn't it? DKK $11.8 billion. Up 12.3% year over year. That doesn't sound catastrophic.
No, on the surface it looks okay. But the market zoomed in on the bottom line. Net income dropped sharply, down 27%. Operating profit fell 30%.
Okay, that sounds bad. Why the disconnect?
Well, this is the crucial detail that gets lost in the scary headlines. The reason for that drop, it was mainly, overwhelmingly, due to a massive DKK 9 billion restructuring charge.
9 billion Danish kroner. Okay, translate that for us. How much is that?
Roughly 1.3 billion US dollars. It's a huge number. And it was tied to this big company-wide transformation project, basically spending money to scale up manufacturing, boost R&D.
So a one-time accounting thing, really, not a collapse in sales.
Largely, yes. It was a non-recurring, non-operational expense hit.
Yeah.
But the market saw that headline net income down 27% and just freaked out. Treated it like the core business was suddenly failing.
That disconnect between the underlying business and the market reaction seems key here.
Absolutely. That's what poured fuel on the fire for the immediate crash.
Yeah.
But, that Q3 report didn't happen in isolation. It really sharpened the focus on what we could call the triple threat of risks facing the company.
Okay, let's break those down. First one, competition.
Right, that initial moat they had, partly built just because nobody else could make enough GLP-1s. That's shrinking fast.
Eli Lilly being the big one.
Eli Lilly, definitely. Their pipeline is looking really strong. And remember that bidding war Novo got into with Pfizer over Metsera? That told us two things, right? One, acquisitions are getting expensive in this space. And two, Novo felt an urgent need to buy new R&D tech just to stay ahead. The race is on.
Okay, threat to pricing pressure. This feels like a big one, especially with all the political noise.
It's a huge long-term headwind, and we're already seeing concrete numbers. Recent deals in the U.S. for GLP-1s are expected to shave, 1-3% off global sales growth starting in 2026?
And the political pressure. Talk of prices potentially dropping as low as $149 a month in the U.S.
Exactly. Even if demand stays sky high, that kind of price compression inevitably squeezes margins. It fundamentally changes the profitability profile over time. You just can't ignore it.
Okay, and the third threat, scalability and the financial health side.
Yeah, the operational reality. We mentioned growth was held back because they literally couldn't make the stuff fast enough.
Right, the manufacturing bottleneck.
Fixing that costs a ton of money. Building factories, securing supply chains. It's incredibly capital intensive.
Yeah.
And you see that strain on their balance sheet now. Well, looking at the Q3 financials, their short-term liquidity looks tight. The debt-to-equity ratio is up near 60%. That's pretty high.
Okay.
And maybe more importantly, the current ratio is only 0.78.
Right. For people not glued to financial ratios, what does a current ratio below 1, like 0.78, actually signal?
It basically means for every dollar of debt they owe in the next year, they only have 78 cents in easily accessible assets like cash, inventory to cover it. Anything below 1 suggests they might be stretched thin in the short term.
So even though they're making tons of money.
Even though it's a cash machine, yeah. But the sheer scale of investment needed to keep up with demand and build capacity means they're relying heavily on debt and financing right now.
Okay, so you've got this incredible demand, but also this huge price cut from the market, combined with rising competition and some financial strain. That perfectly sets up this massive valuation reset we've seen.
Absolutely perfectly. Before this crash, Novo wasn't priced like a pharma stock. It was trading like a tech growth darling, right? PE ratios in the high 20s, maybe even touching 30x sometimes.
And now, after the sell-off.
Totally different picture. The trailing 12-month PE is down in the 12.5x to 14x range, much more in line with, say, a Merck or a Pfizer. It's been completely re-rated.
And that re-rating has caused huge disagreements about what it's actually worth now. I saw one DCF model discounted cash flow pegging the fair value at $163.42.
Yeah, I saw that too, which would mean it's, 72% undervalued right now?
Crazy upside if that model's right.
If it's right. You have to ask, what assumptions about market share, competition, and long-term pricing does that model bake in to get to $163? It implies near-perfect execution and continued dominance for years. A big leap of faith, maybe.
Definitely a bullish take. What about the broader analyst consensus? Is it that optimistic?
More cautious, but still pretty positive. The average analyst target price is hovering around $80.40. Still implies, roughly 76% upside from where the stock is today. So even the more conservative view sees significant value.
Okay, but then there's the bearish view, which must be focusing on the slowing growth forecasts.
Exactly. That's the justification for the low PE multiple we see now. The forecasts show a pretty dramatic slowdown. Revenue growth expected around, 5.6% per year going forward?
Yeah, and earnings growth only about 6.9% per year.
And you have to put that 6.9% earnings growth in context. The broader U.S. market is forecast to grow earnings maybe 16%. So if Novo's growing slower than the average stock,
then a PE of 12x or 13x doesn't seem so crazy, does it? It seems kind of justified.
It does. But this is where the bulls push back hard. They say, okay, maybe hypergrowth is over, but look at the quality and efficiency of the earnings.
And that comes down to that key metric, return on equity or ROE.
That's the killer stat for the bulls. Analysts still have a buy or overweight consensus, largely because the forecasted ROE is phenomenal.
How high are we talking?
Expected to hit 49.3% within 3 years. Almost 50%.
Wow. Okay, put 49% ROE into perspective for us.
I mean, most big pharma companies would be ecstatic with 20%, maybe 30% ROE. Getting close to 50% means the business is just incredibly efficient at generating profit from the capital invested in it. It needs very little shareholder money to make huge returns.
And that efficiency is the argument against the pricing pressure concerns, isn't it? If your margins are that fat to begin with.
Precisely. Even if prices come down 10 or 15%, A business this efficient can still be wildly profitable. It suggests huge underlying strength and pricing power, even if the absolute price point shifts.
So it signals that even if the crazy 30% growth days are done, this isn't a fundamentally broken company, it's just re-rated.
Hmm.
Moving from that tech-like darling back to being an elite, super efficient pharma compounder.
That's the core debate, I think. Re-rated, not broken.
And understanding that difference really helps frame who this stock might be suitable for now, for you, the listener. It's not for everyone anymore.
Definitely not. It seems to appeal most strongly now to, say, two types of investors. First, the long-term compounder type. People focused on durable businesses, strong margins, that super high ROE, and who can stomach the healthcare-specific risks, competition, regulation.
Okay. And the second group?
Maybe the high conviction value investors, the ones looking at that massive gap between the current price and those fair value estimates, trying to capitalize on what they see as market panic over temporary issues.
But it's clearly not for someone just chasing immediate high double-digit growth anymore. The market's saying that chapter is likely closed.
Right. The story has shifted. What really stands out is just how wide the gap is between that current low PE and the incredible underlying efficiency shown by that ROE forecast.
We've seen the stock slash nearly 60% off its peak.
Yeah.
Yeah, there were one-time charges, there are real concerns about future pricing, but that fundamental engine, the global need for these therapies, is still humming. And that efficiency, nearly 50% ROE, it's remarkable and makes for a fascinating setup.
It really does.
Is Novo Nordisk a once-in-a-moment dip? Or the market finally slowing down the obesity hype train?
Appreciate tuning in. Until next time, stay sharp, stay patient, and let the market work for you.